Do you want to slash your tax bill? You can, and without giving up a single dollar you already have. The tax code literally rewards you for making certain type of investments. They are called tax-deductible investments. They let you do two things at once. First, build wealth, and second, lower your taxes. Hello, my name is Veronique. I'm an accountant, a tax strategist, and a business coach. As a tax strategist, I've personally saved my clients thousands of dollars using these exact strategies. Comment below if you have any questions. And don't forget to like and subscribe for more tips on how to save thousands in taxes that you're already paying. Let's break down how this works. Your tax is based on your income. So the more you earn, the higher your tax rate. But when you make a tax-deductible investment, you are literally pushing income off your tax return for the year. Example, let's say you earn $100,000. By making a $25,000 tax-deductible investment, you just lower your taxable income to $75,000. And if you're in the 22% tax bracket, that one move saves you $5,500 in taxes. And for someone in a higher bracket like 37%, with the $20,000 deduction, can save around $9,250. Your tax savings will depend on your income and your tax bracket. So now let's dive into the various types of tax-deductible investment, from the most common to the more advanced strategy. The number one investment is the traditional IRA. The traditional IRA is an individual retirement account that anyone with earned income can set up for free at a brokerage firm. You can contribute up to $7,000. And if you are 50 or older, you can contribute up to $8,000. That amount is a tax deduction for you, and your spouse can do the same. And you can even set up one for your kids as long as they have income. The key benefits to that, the money grows tax free, and you only pay taxes when you take a withdrawal or during your retirement. This is perfect if you're in a high tax bracket today and expect to be at a lower one when you retire. But just be aware, if you cover in your workplace and the 401k and your income is above $87,000 for a single or $143,000 for a married couple, your deduction may be limited. The second investment is a traditional 401k. This is just like an IRA, but with much higher contribution limits. You can use a 401k through your employer, or even better, if you have your own business. You can set up one for even more benefits. As an employee, you can contribute up to $23,500 of your wages, and that entire amount is a tax deduction. If you have a business, you can also contribute as an employer up to 25% of your business income for a bigger tax saving. The third investment, the health savings account, for short, HSA. That's your triple tax advantage powerhouse. The health saving account, or HSA, you get a tax deduction for your contribution, and your investment grows tax-free. And when you use the money for qualified health expenses, it comes out tax-free, which means you can effectively never pay tax on the money inside your HSA. Investment number 4, the donor advised fund, short DAF. If you are already a regular charitable giver, this is a game changer for you. The donor advised fund is like a charitable savings account. The more you put of the money in the fund, you get an immediate tax deduction. And you can then take your time to give that money to charities over the next 5, 10, or even 15 years. Plus, you can invest the money and the fund to grow it tax-free. These are powerful tools to build wealth while you are saving on your taxes. If you have questions about which of these is right for you, or if you want to explore more advanced strategies like using a small business or real estate for tax savings, let's connect. Remember, don't leave money on the table.